Okay, so good evening to all the participants and namaskar. My name is Joydeep Sen. I'll be your host for the next 1 hour. So today's session, as you are aware, today's session is about hybrid mutual funds, a means of allocation. So a few words before we start. This session is sponsored by NISM. NISM, as you all know, is the education arm of SEBI. So NISM, which is established in 2006 by SEBI as a public trust. And SEBI, as you all know, is the regulator of the securities market in India. And this institute carries out a wide range of capacity building activities at various levels aimed at enhancing the quality standards of security markets. So it is not only about certifications which people require for pursuing various investment activities or investment advisory activities. It's also about capacity building, enhancing the level of the quality standards in the education and securities industry, and also about enhancing awareness like what we are doing now. So in today's session, as we said, we will discuss hybrid mutual funds as a means of allocation. So the pattern will be, I will talk now from now till maybe say 4:45, 4:50 approximately. And we will take questions towards the end, like 4:45, 4:50 onwards. We will take questions and discuss. And participants will get certificates. I can see the questions on the chat box that we will address little later, maybe towards 4:45, 4:50. So I will start sharing my screen. And what we will cover today is briefly, what is mutual fund? Briefly, what is allocation? Then about hybrid funds, what are the parameters, profiles of hybrid funds? And ultimately, hybrid funds as a means of allocation. So I will just start sharing my screen. Just give me a second. Okay, so as I said, before we go on to hybrid mutual funds, just a few words about what is mutual fund. A mutual fund is a pool of money where contribution is taken from public all over the country. People contribute and the money is pooled and the money is invested in the securities market. So we can see the screen. What is a mutual fund? What is the concept? So mutual fund is an investment vehicle where everyone pools in their money and is invested. So you can read the text and you can see the screen. So what is the analogy here? So when you have to travel somewhere, you can either travel by your own transport. You may have your own car or other means of transport, where you have freedom, you have flexibility. What you want to do, where you want to go, when you want to go, all that freedom, flexibility is there. However, there is more responsibility on you, and you have all those baggage and luggage, what to do, the entire responsibility and the entire thing. Whereas if you go in a public vehicle, while you have to go as per the timing of that public vehicle, it could be train, could be flight, could be bus, could be whatever, your time is free and you can utilize your time, you can enjoy your time. So similarly, mutual fund is like a bus. So in this bus, I'll show you that now. So the analogy is the bus is the mutual fund where the passengers are the investors. So in one mutual fund scheme, there are thousands and lakhs of passengers who have pooled in the money. The bus is the mutual fund where everyone gets in the particular scheme. There are multiple schemes run by one mutual fund. The fund manager is the driver. So like the driver navigates the route. So the road is so and so, accordingly the driver drives the vehicle. Fund manager is the driver. And the bus route is the scheme objective. So there are so many mutual fund schemes, equity, debt, hybrid. And within equity, debt, hybrid, there are so many fund types. So that objective. So the common thing is like in a bus, all the passengers have a common route, a common place to go, maybe somewhere on the way or the ultimate destination, but a common route. Similarly, all the investors in one fund have subscribed to that common objective. That is the scheme investment objective. And the bus route is similar to that. So that broadly is the concept of mutual fund. Now look at the role of mutual funds. What does a mutual fund do? The mutual fund assists investors in earning an income or building their wealth. So when you are earning money, when you are say 30-year-old, 40-year-old, you're earning money and building your corpus for, let's say, retirement or some other investment objective, while you can do it on your own. You can on your own buy equity stocks, you can buy bonds and all those things. So this is a specialized vehicle where you get the expertise of the fund manager. A fee is there. The mutual fund cannot come free. There's a fee to it. But in exchange for that fee, there is a professional team in charge and who are running the show. And with the help of this investment vehicle, you can build your wealth as long as you're earning from 25, 30 years to 40, 50, almost 60 years of age. Now, how does it benefit governments, companies, or other entities? For a growing economy like India, companies need money. Companies issue equity stocks, companies issue bonds, governments issue bonds. So all these various entities, while they issue stocks, bonds directly as well, mutual funds also are one of the subscribers. So mutual fund collect money from the public and invest in these instruments. Keep a check on the operations of the company. What it means is corporate governance. So mutual funds being shareholders, substantial, significant shareholders in so many companies, they also can have a say in how the company is run. Mutual funds promote economic development and nation building. How do they do it? So when others gather resources through the mutual fund route, like governments issue bonds, companies issue stocks, companies issue bonds. So that way, like banks do, collect money from the public at large, deposits, and give loans to industry, to individuals. Similarly, mutual funds play a role by collecting money from the public and channelizing that to various companies and the government as well. And mutual funds are a key participant in the economy. So in the capital market, if you have tracked this data, if you look at the ownership pattern, so the ownership pattern of equity stocks are like that. Today, mutual funds have a larger holding than retail investors. If you look at the traded volume, investors' retail participation is higher. But if you look at the ownership pattern, so mutual funds own like more than 10% of the outstanding stock of companies, whereas retail participation is like 9.8 or something, little less than 10%. So that is the significance in the equity market. In the debt market also, in the short term, like CDs and CPs, less than 1 year market, mutual funds are significant players. In corporate bond market also, mutual funds are one of the significant players. So that is the importance, the role played by the mutual fund industry. So what is the structure of the fund industry? You can see here. So there are so many investors like the passengers in the bus, that is the pool. They pull in their money. The fund manager invests the money in various securities like stocks and bonds, generate the returns. And the returns, net of the fees charged by the mutual fund, is given back to investors. Now, when I say given back to investors, there are two forms to it. One is dividend, what is now called IDCW. IDCW as in income distribution cum capital withdrawal option, which was earlier called a dividend option, or the growth option. So in the growth option, nothing flows to you automatically. It remains in the NAV, NAV as in net asset value. Whenever you withdraw, your money comes back to you. Whereas in the dividend or IDCW option, there's a defined period, could be quarterly, could be annual, could be daily, could be weekly, 6 monthly, whatever. At that defined frequency, some money, some dividend flows to you. In a growth option, everything remains in the NAV. Whenever you want, you can withdraw. So that is the structure of a mutual fund. So we move on to the concept of allocation. What is this allocation? So allocation, one thing you all know is don't put all your eggs in one basket. However, there is more to allocation. So when we say in a portfolio, you must allocate. As an example, if you have a portfolio comprising, say, large cap, mid cap, small cap, and that kind of thing, it is not really allocation because ultimately you have everything in equity. If you want to diversify and if you want to do judicious allocation, you have to allocate to multiple asset classes like equities, bonds, gold, silver, real estate in financial form, various asset classes. Now, what is the essence of this? The essence of, it is not just about putting your eggs in different baskets, but there is a science to it. And that science is different assets behave differently in a given market situation. So they balance out each other. So overall volatility in the portfolio is that much lower. So you can see here. So the negative correlation between various asset classes is the rationale for doing a diversification allocation in a portfolio. Now, this negative correlation is not really perfect, but yes, it gives you some balance in the portfolio. So as an example, if the GDP of the country is growing fast, equity will do better because the economy is growing, the GDP of the country is growing, corporate top lines are growing, so corporate bottom lines are growing, so corporate EPS is growing fast. However, when the economy is growing fast, then demand is higher. When demand is higher, inflation would move up. So when inflation is moving up, the central bank of the country, which is the Reserve Bank of India, they would hike interest rates. And hiking interest rates is not good for debt. and vice versa. When the economy is not growing fast, equity is not doing well, inflation is low, RBI will cut rates to promote growth. So various assets behave differently in a given market situation. It's not perfect negative, but to whatever extent it is negative, they balance out each other. That's the concept of allocation. Now, when we say allocation, there are broadly two types of allocation. You can see the screen. So I hope my screen is visible. Strategic and tactical. So strategic is you take into account your relevant variables. What is your objective? Why are you investing? What is your investment horizon? You're investing for 1 day, 1 year, 10 years, 30 years. How much of volatility you can withstand? What is your risk appetite? So taking into account all these variables, you do the strategic asset allocation. So financial planning theory says that your strategic asset allocation should not be dependent on the market level. As an example, equity market has run up, equity market has gone through a correction. That should not decide your allocation to equity. It should be decided on the basis of your scheme, your objectives. What is your investment objective, your horizon, like 1 year, 10 years, 20 years, 5 years, and how much of appetite you have, like how much of volatility you can digest. Whereas tactical asset allocation is that so to a certain extent, the market situation can influence your allocation. As an example, if you are thinking 60, 30, 10, 60% equity, 30% of debt, 10% to gold. If equity market valuations are cheaper, like PE ratio is attractive, then you can have, say, 70% in equity and little lower in debt. If equity market has run up and valuations are stressed, instead of 60, you can have 50% in equity. So that tweak at the margin, that can be the tactical allocation as per the prevailing market situation. So now we come to mutual fund categories, because I'll talk of that first, then move on to hybrid fund categories. So as per SEBI definition, there are multiple mutual fund categories you can see here: equity, debt, hybrid, gold, international. So the essence of this categorization is that in one mutual fund category, one mutual fund can have only one fund. Like large cap, one mutual fund can have only one large cap fund. They cannot say this is my large cap fund A, large cap fund B, and C, and so on. Only one large cap fund. Only one mid cap, only one small cap. Exceptions are there, like thematic funds, sector funds, they can have multiple. Fund of funds, they can have multiple. Index fund, ETFs, they can have multiple. But in the normal, usual categories, like large cap, mid cap, debt funds, they can have only one fund per category applicable to open-ended funds. So how many categories are there? You can see the screen now. In equity, there are 11 fund categories. In debt, there are 16 fund categories. Hybrid, there are actually 6. I've mentioned 7 here. So I'll show you on the screen that between 2 and AMC can have only 1. So counting that as 1, there are 6 subcategories in hybrid. And we have these things called solution-oriented and other schemes. So now we come to hybrid funds. Like the topic is hybrid funds, a means of allocation. So this we will discuss in some detail. So look at the screen. Firstly, there is this conservative hybrid fund. What is the definition? Equity allocation is 10% to 25% of the total assets. So basically, it's a fixed income oriented fund where up to 90% or 75 to 90% is in fixed income, which is basically debt, and 10 to 25% can be in equity. So a fixed income oriented or debt oriented fund with some allocation to equity. So earlier days means before the SEBI categorization came in October 2017, this category was called MIP, monthly income plan, for some reason. Now it's called conservative hybrid fund. Conservative because equity allocation is low, like 10-20% only. Now you see between these two categories, balanced hybrid fund and aggressive hybrid fund, one mutual fund can have only one, not both of them. Which is, I said, there are 6 categories. If you count all of them, it is 7. But counting balanced and aggressive as one, a mutual fund can have only one fund. So what is the definition? In a balanced hybrid fund, equity can be 40 to 60% of the scheme of the fund, and in aggressive hybrid fund, 65 to 80% can be in equity or should be in equity. Now, the entire industry or most of the industry has chosen aggressive hybrid fund. Why? From the taxation perspective. From the taxation perspective, the definition of a fund like equity or debt, that definition is 65%. So as you can see on screen, if in a fund, equity is 65% or more, That is defined as equity fund. And as you all know, taxation for equity funds is attractive, better than debt funds. And people prefer equity taxation. So mutual funds have chosen aggressive hybrid fund category over balanced hybrid funds. Maybe one or two mutual funds here and there may have chosen balanced hybrid fund. You can, equity is 40 to 60%. So taxation is like that of debt because allocation to equity is less than 65% of the portfolio by definition. So conservative hybrid fund, little bit in equity, aggressive hybrid fund, more in equity. More means what? 65 to 80% of portfolio. Now look at this category, dynamic asset allocation, or industry calls it BAF. BAF as in balanced advantage fund. We'll discuss more in detail a little later. What it means is, in a balanced advantage fund, BAF as the industry calls it, there is an apparent equity exposure, which is 65% or more. Why? Because of the equity taxation. When the fund has 65% or more in equity, it is classified as equity for taxation purposes. However, the fund manager goes short. Goes short means the fund manager takes a contra position. So buy position here in the apparent equity, contra is in a sell position or short position in derivatives market. So by virtue of that contra or short position, the effective equity exposure is negated to that extent. As an example, if the fund has 80% equity apparently, and 40% they have shorted, gone short as in contra position, that means effective equity allocation is 40% only, which means if the equity market rallies, you will get the benefit to the extent of 40% only. If the equity market tanks, if the equity market corrects, you will lose to the extent of 40% only. So why have this fund category? So while there are pure play equity funds, there are pure play debt funds, and there are other hybrid funds as well, like we just saw. We have aggressive hybrid fund, we have conservative hybrid fund. But here, the extent to which the fund manager goes short, as an example, if 80% is apparently into equities, to what extent the fund manager will go short, that is managed dynamically as per the AMC's reading of the market situation. Market valuation is attractive, market valuation is stressed. As per that, it is done. Multi-asset allocation. So as you can see on the screen, the SEBI definition is at least 3 asset classes and minimum 10% in each asset class. So the way the industry, the market perceives it is equity, debt, gold, equity 65% or more, balance in debt and gold. So that is the usual perception, and that is how usually these funds are run, but nothing hard and fast. So as per SEBI definition, a multi-asset allocation fund can be debt oriented also, as long as equity is more than 10 or gold or any other, or silver or any other asset class is more than 10%. That is the definition, that is the requirement from SEBI. Because of taxation, most of the industry runs as equity 65% or more, but there are certain AMCs which run as a debt-oriented fund, 65% or more in debt or 65% less in debt, depending on the tax positioning which they run. Arbitrage, we will see more in detail. What is the concept of arbitrage? In the equity market, there is one cash or spot market, and there is one derivatives market. So in an arbitrage fund, the mutual fund manager takes a buy position or long position in the cash or spot market, and takes a contra position as a sell position or short position in the futures market, stock futures market. These two negate each other, cancel out each other, which means equity market goes up or equity market comes down does not really matter. The fund earns from the differential. As an example, if the price of a stock is say rupees 100 in the cash or spot market, and the price is say 100.5 in the futures market, so then you are buying it at 100 and you are selling it at 100.5. That 50 paisa is the differential, which differential, that is the earning of the fund for that month. Month means, so there are stock futures of multiple maturities. So usually they do monthly contracts only. So there is one same month, near month, and far month. So the near month contract is the more liquid and less volatile one, and that is what mutual funds usually run in their arbitrage funds. And finally, we have this category called equity savings fund. You can see the definition on screen: 65% or more in equity. So here, what I do in equity savings fund is there is one open or usual equity, like say 20, 30, 40% of the fund. There is a hedged equity. Hedged equity means, like in arbitrage funds, you have one position, you have purchase or long position, and you have a contra position in the derivatives market. So in the equity savings fund, there is one usual open equity unhedged, like 30, 40% of the portfolio. You have hedged equity, like 20, 30% of the portfolio. taking these two together, as in the normal open equity and the hedged equity together, should be 65% or more. So taxation is equity, and the balance is in debt or money market instruments. So that is this thing about arbitrage funds. So we'll discuss more in detail and we'll recap here. Aggressive hybrid funds, 65 to 80% of the portfolio in equity. So broadly an equity-oriented fund. BAF funds, in a way similar, 65% or more in equity, but in BAF funds, they go short to an extent. To what extent the fund manager will go short? Say if they are long, say 65% of portfolio, 70% of portfolio, 75% of portfolio. Against a 65% or 75% of portfolio which they have gone long, as in purchase position in the cash or spot market, to what extent they will go short is up to their reading of the market. So that's about balanced hybrid funds. So balanced hybrid funds are called counter-cyclical, as in the market is going in a certain way, but when the market is running up, valuations are getting stretched. So when valuations are getting stretched, usually the fund manager will increase the short position and reduce the net effective equity exposure, so that if the market corrects, then the impact on the fund will be lower. That's about BAF funds. Then we have multi-asset allocation funds, 3 asset classes minimum, and 10% or more in each asset class. And usually the way to do it is 65% or more in equity, balance in debt or gold or silver. Equity savings we have discussed, 65% or more in equity. Equity as in combining the usual open unhedged equity and the hedged equity. Conservative hybrid, debt-oriented fund, little bit in equity, 10-25% into equity. And arbitrage funds. In arbitrage funds, there is no open equity exposure. To whatever extent they have a short position in the long position in the market, the entire extent they have shorted, taken a contra position, and there is no directional exposure to equities in an arbitrage fund. So you can see it again, same thing I'm repeating. This gives you a better visual representation of what these hybrid funds are, what they do. So in a dynamic asset allocation fund or a BAF fund, it can be equities like the entire range. They can go any range. So there is no SEBI issue on that. Usually they have 65% or more from the taxation perspective, but they can be 0 to 100. Multi-asset fund, minimum 3 asset classes, 10% minimum in each asset class. So equity can be this much percentage of the portfolio. Aggressive hybrid, 65 to 80% is into equities. Balanced hybrid, they can have only one. That's why this caret sign is there. And AMC can have either aggressive hybrid or balanced hybrid. So this much is in equities and taxation is non-equity. And conservative hybrid, taxation is debt, and it is a debt-oriented fund. Arbitrage, arbitrage between the equity cash or spot market and the equity futures market, stock futures market, and equity savings we discussed. So these broadly are the hybrid fund categories. We will now look at what the market is doing. Now, what the market is doing is not like a yardstick or not like a be-all and end-all, but gives you some perspective as to where broadly large investors are going. So this gives you the monthly AUM trend of hybrid funds. So you can see here, BAF funds have a significant corpus. April 25, almost 3 lakh crore, 292550. So almost 3 lakh crore is the corpus size of BAF funds. And it has moved up significantly. You can see the percentage. It has moved up significantly. So why so? When equity valuations are stretched, and if as an investor you are wondering, I do believe in the India growth story, I do believe in equity, but valuations are stretched. So how much should I invest in equity? So one way is, okay, you take a call, you talk to your advisor, talk to your distributor. That is one way of doing it. Or you give it to an AMC. In the AMC, it is run by a fund manager who is a professional, whose job is to track the markets, who knows better. And depending on the AMC's, the investment team's reading of the situation, they will decide how much is to be shorted and how much should be the effective equity exposure. So that helps. And all know the equity market valuations. So a correction happened October 24 onwards. Market went through some volatility. All these things happened. But yes, given the equity market situations, investors are taking a liking for this BAF category. Balanced hybrid or aggressive, like I said, it is mostly aggressive. Some AMCs may have balanced funds. That also is getting money. Why? Because people who have a belief in equity but want to be a little conservative, in the sense instead of 100% equity, you have like 65, 70, 75, 80% in equity. That is why aggressive hybrid funds are getting this thing, getting money. Arbitrage funds, so typically how arbitrage funds are positioned is that somehow some people position it as a liquid fund substitute, position this as a parking product, but it is not a parking product. In an arbitrage fund, ideally your horizon should be 1 year, if not 1 year, at least 6 months. Why? The market goes through fluctuations, market goes through volatilities. People say that arbitrage funds being equity from the taxation perspective, you hold for 1 year, you pay tax at 12.5%. You hold for less than 1 year, you pay tax at 20%, which is correct. But the point is, that is the taxation aspect only. The NAV is valued every day, and the NAV is valued at market price levels. And market price, as you know, can be volatile. So if your horizon is say 1 week or 2 weeks or 1 month, that should go into liquid fund, not arbitrage funds. If your horizon is 6 months, 1 year, then go for arbitrage funds. And yes, taxation advantage is also there. Liquid fund, debt taxation, you pay a higher tax. Arbitrage fund, equity taxation, you pay a lower tax. Multi-asset, again, it's a function of the taxation. If it is an equity-oriented multi-asset fund, like 65% or more in equities, taxation is equity. And there is certain positioning. So if it is I've not shown it here, but there's something called fund of fund, multi-asset fund of fund, and some AMCs have done that positioning. So in a multi-asset fund of fund, you buy the fund today, you hold for 2 years, and taxation is 12.5%. And if it is a debt-oriented fund of funds, then fluctuations are lower, volatility is lower. You hold for 2 years, and you pay tax at 12.5%. Equity savings fund. So somehow market has not caught fancy for equity savings fund, and conservative habit funds like debt funds only. So only a little bit is in equity. So what is the market like in terms of market AUM? Where is the market putting in their money? You can see here. BAF funds, market like it. Like the fund manager takes a call, how much would be the effective exposure to equities? Aggressive habit funds, yes, mostly equity, little bit of debt. Arbitrage funds are differential between, and typically when the market is volatile, the spreads between equity spot and equity futures moves up, and that helps returns. Multi-asset also has been doing well of late because equity market has been volatile, and exposure to multiple assets does help. So here I'm showing you the monthly flows. So green means good flow, red means bad flow. So look at the flows here. Arbitrage has been really volatile. In April, so much positive, getting fresh funds. March, so much negative, and all that. But yes, arbitrage funds are getting money, like we saw in the table in the earlier one. BAF funds, it's a mixed picture. They are getting money. Aggressive habit funds also a little bit mixed. Multi-asset funds are getting money, mostly green ticks, and conservative habit is losing money. Here you get one shot view of all the habit fund categories. So arbitrage fund, 65% or more into equities. So while AMCs have the freedom, the flexibility from SEBI's perspective to invest more than 65%, usually they cannot go too much. So why is it that firstly, to take a position in the equity futures market, they have to give a margin, and that margin they have to have in money market instruments. That takes about say 20% or so. Sometimes the market can be volatile. There may be mark-to-market calls to have to keep 20% or higher in money market instruments. So when arbitrage spreads are high, AMCs may go up to say 70, max 75% in the equities in the arbitrage, not more than that. Average net equity is zero in arbitrage fund because there is no directional call. Returns come not from equity price going up, but returns come from the differential of the spread, price in the cash or spot market and price in the stock futures market. So average is 65 to 75% of the portfolio. Then conservative habit fund we have discussed. There is a simple product, little bit in equity, and debt is, you can see here, 75 to 90% of the portfolio. Equity savings funds, equity is more than 65, that is combining the two, open usual equity and hedged equity. And then the balance is in debt or money market instruments. BAF fund, it is 0 to 100 into equities. From SEBI's point of view, usually what they do is 65% or more into equities, apparent or long equity from taxation perspective, and they go short to a certain extent, and that is the balance. Multi-asset, definition is 10% or more in equities or any asset class, but usually they have little bit largish into equity. Industrial, you can see we saw earlier how much money is there in the various fund categories. This number of schemes gives a perspective, as in if a category is popular, out of the 46 AMCs, more AMCs will be enthused to float a fund in that category. So what we see here, BAF funds are popular. 35 mutual funds have funds in that category. Arbitrage is popular. 32 AMCs have that. Conservative habit not so popular. 18 funds have that. Equity savings is okay. 23 AMCs have funds in that category. Multi-asset is popular. 28 AMCs have funds in that category. So why multi-asset is popular? Equity market can be volatile, and allocation to various assets help. Various assets means equity, debt, gold, or silver, or international equity, any other asset class. Arbitrage fund, very low volatility because earnings are largely from the spread. Some volatility can be there, what is called mark-to-market volatility. So NAV is valued every day and price can fluctuate, but what you capture? Capture means the differential of spread between the cash and the futures market that is committed, that income you will get. Conservative habit, very low because equity exposure is very low. Equity savings fund is low because open equity is like 20, 30, 40% only. BAF is medium and multi-asset also is medium because there is some equity exposure in that fund. So we move on. So we discussed what is the concept of arbitrage, the price differential between the cash and the futures market. So if you recall earlier days, like say 30 years ago, when trading systems are different, today it is all computer system, algo and all that, and you trade online. Earlier days when computers were just starting or even before the computer days, so settlement is to happen on a settlement period basis. So Monday to Friday is to be one settlement period. Those days, nowadays T+1, T+2, SEBI is talking of T+0 also. So in today's T+2, T+1 kind of settlement, it is different. But in those days, if you want to carry forward your trade from one settlement period to the next one, it has to be settled in one settlement period and carried forward. So if you want to do that, another market participant, another trader has to fund that trade. So somebody will do that if you pay him the price or the cost of it. So in a way, it is the cost of funds. So the earlier days, 30, 40 years ago, it was called Badla. Badla as in, I am putting in my funds to help you carry forward your trade from this settlement period to the next settlement period. So Badle mein kitne doge, that kind of concept was there. Today, systems have changed, but concepts are, the basic concepts are similar. So this price differential, let us say in this example, 100 in the spot market and 100.5 in the futures market. This differential is, in a way, the badla or the cost of funds being carried, or the cost of money, because I am funding your trade to be carried forward. So what the mutual fund is doing, taking advantage of it, buying in the spot market at 100 and selling in the futures market at 100.5 and pocketing that differential to the extent of 65% of the portfolio. So this we have discussed. I'll repeat one point here, one important point here, because many people in the market position arbitrage funds as a parking product, as a liquid fund substitute, which is not the case. Why so? So I have said this multiple times. NAV is valued every day. And how is NAV valued? For the long position, usual, the closing price or the VWAP price in the cash or spot market. For the futures positions, the valuation level is given by the exchanges, NSE and BSE, and they have their complicated valuation models for that, like Black-Scholes model and all those things they have, and they'll give the valuation. Now, on a given day, market can be volatile. As an example, if the spot price comes down, it can happen on a day, spot price comes down, your NAV comes down. So this thing, it is done on the last Thursday or the last working Thursday of every month. That is called the expiry Thursday. So from one expiry Thursday to the next expiry Thursday, this next month's expiry Thursday, while you have captured that spread, that differential which you will get, in the interim, the market can be volatile. Valuation levels of your cash position, of your future position can be volatile. So this can lead to volatility. And if your horizon is say 1 week or 2 weeks or 1 month, this is not the product. And if you have tracked the markets in March 2020, just around the COVID period, April 2020, during the COVID period, arbitrage funds were very volatile and there was large scale redemption. Nothing wrong with the concept of arbitrage, but the volatility unnerved people and people withdrew. September 2020 also, market was volatile. These funds were volatile and people withdrew from arbitrage funds. which is why a longish horizon is required. Why? Because a longish horizon, like 6 months, 1 year, takes care of market cycles. Markets go through cycles, and if you have time on your side, it is taken care of. So this we have already discussed. 1 year you get taxation, you pay tax at 12.5%. Less than 1 year you pay at 20%, but still it is lower than debt funds. So BAF also we have discussed. There is an apparent equity exposure. Now in BAF funds also somehow the perception in the industry, the distribution community, investment community is that they move from equity to debt, which they can do. As an example, if a BAF fund has, let's say, 75% in equity and market valuations are stretched, they can move from 75 to 65% in equity, which they can do. But the real play, the real game is not about that. They have an equity apparent exposure, long exposure. How much they will take a short position, how much they will take a contra position, the game lies there. So if an example, as an example, if an AMC has, let's say, a 75% equity long exposure, out of that 75% equity long exposure, they will go short to the extent of 10%, 20%, or 40%, or 50%. That is decided by the fund management team. And that is where the game lies. So it is not exactly about moving from equity to debt or debt to equity. It is about how much fine tuning that extent of short, so that the extent of open exposure in the market, in the equity market, is taken care of, is fine tuned as per their reading of the market. That is about BAF fund. So the pitch or the positioning of BAF fund is that if in your portfolio you're not sure how much of equity exposure you should take, give it to an AMC BAF fund where the fund manager is in charge, who knows better, who is a professional, and decides the net equity exposure. Multi-asset we have discussed. 65% or more is usually into equities, but about 7 or so AMCs have non-equity positioning as well. Again, they have a different positioning from the tax point of view. Equity savings funds also we have discussed, so I will skip this. So now coming to the crux of today's discussion, what is allocation through hybrid funds? So in your portfolio, you're an investor. In your portfolio, you have so much in equity, so much in domestic equity, so much in international equity. You have debt, you have liquid, you have gold, you have silver, you have REITs, invest, and real estate in financial form. So many things, so many asset classes you have. That is how ideally your portfolio should be constructed. So you can either do it individually, like so much to equity, so much to debt, so much to gold. Now you can do this allocation through hybrid funds also. So what are the pros and cons of doing it through pure play funds, or doing it through, let's say, you're buying stocks or bonds directly, or through hybrid funds? In a pure play fund, it is more well defined. Like in a large cap fund, it is defined by SEBI, 80% or more in large cap stocks. In a multi-cap fund, it is defined 25% minimum in each of large, mid, and small. However, in an aggressive hybrid fund, SEBI definition says 65 to 80% is in equity, that's all. It does not say that large cap or small cap or sector or theme, that is not defined. So if you want a more defined, pure kind of exposure, you go through specialized funds like large cap, multi-cap, small cap, where it is more well defined. However, another thing is that if you do it on your own, the discipline may be missed out. So what does it mean? Let us say you decide on a ratio of, say, 60-30-10, 60% to equity, 30% to debt, 10% to gold. Equity market rallies, 60 becomes 70. Even though we decided 60% for equity, you're not correcting, not changing it after the equity market rally, because equity market is rallying, everything is bullish, and you have a feel-good factor. So if the market corrects, you are exposed to equity more than you should be. However, in a hybrid fund, since it is managed by a fund manager, managed by a professional, the fund manager has to follow a discipline. Or whatever the fund manager does, he or she has to have a rational justification why he or she is doing it. So in a hybrid fund, it is done in a more disciplined manner. As an example, in a aggressive hybrid fund, the fund manager cannot go beyond 80% in the equity, however bullish he or she is, or cannot go less than 65% in equities, however bearish he or she is. That discipline is maintained in a hybrid fund. So that is the pro and con about doing it through pure play funds, or you're buying stocks, bonds directly, or doing it through a hybrid fund of mutual funds. So if you want a more disciplined kind of approach, you give it to hybrid funds. And if you want more flexibility, then you can do it on your own, or you can do it through pure play funds. Another development is that earlier days, investment into bond funds or debt funds had a taxation benefit. They had the indexation benefit. So 1st April 23 onwards, your fresh investments into debt funds does not have the benefit of indexation. So from 1st April 23 onward, what happened is a certain section of the investors, they preferred hybrid funds from the taxation point of view. Indexation benefit is gone. So as an example, if you invest, say, aggressive hybrid fund, taxation is equity. If you invest in equity savings fund, taxation is equity. You invest in arbitrage fund, taxation is equity. So from that point of view, some investors prefer a hybrid fund. So nothing wrong with that. Only thing is, take care of the overall exposure in your portfolio. Like equity should be so much, debt so much, gold so much, liquid so much. That overall allocation should not go here and there. You have to take care of that. Otherwise, you can do it through hybrid funds as well. So I'm almost near about my PPT. So I will just reiterate a few things and then go for an open discussion. So I will show you the definition once again, the definition of the 6 hybrid funds. So this is the definition. BAF funds, as per SEBI, equity can be the entire range. But usually what they do is they have, say, 65, 70, 75% in equity, apparent or long equity from taxation point of view. And net of the short positions, net exposure to equity is like, say, 30, 40, 50%, usually, depending on the AMC, on their reading of the market and all that. Multi-asset fund, mostly equity, 65% or more, balance in equity, balance in debt or gold or silver or international equity. Aggressive hybrid, 65 to 80% in equity. Balanced hybrid, I mean, it's usually not there because an AMC can have only one, either aggressive or balanced hybrid fund, and the industry has mostly gone for aggressive hybrid fund. Conservative hybrid, not very popular because it's a debt-oriented fund. And if I have 80-90% in debt, I can as well go for a pure play debt and pure play equity fund. Arbitrage funds, they play between the equity spot or cash market and the equity future stock futures market. And there is no directional call on equity. What it means is the returns from a arbitrage fund does not come from equity stock price going up, but from the differential in price between the spot market and the futures market. Equity savings fund, a combination of open equity, unhedged equity, hedged equity, and debt money market instruments. So I will pause my PPT here, and I believe there are quite a few questions. Okay, so I'm seeing it now. Can you go back to page 21, please? So I don't remember what is, can you tell me what is this page 21? What was it? Page 21, yeah. This is page 21. So what are arbitrage funds? They earn from the price differential between the equity spot and futures market. They take a sell position, the mutual fund takes a sell position. They usually do it on the last Thursday, the last working Thursday of the month, which is called expiry Thursday. So now they are talking of changing the expiry last day, like from Thursday or Tuesday or Monday. So SEBI exchanges, they are at it. So some different day may be decided, but as of now, it is the last working Thursday of the month. And the price differential gives the returns to arbitrage funds. Okay, one question here. How BAF is different from aggressive hybrid fund? The difference is in an aggressive hybrid fund that exposure to equity, 65 to 80% to equity, is plain, simple, pure equity exposure. Whereas in a BAF fund, while there is an equity exposure, 65, 70, 75%, in a way similar to an aggressive hybrid fund, that equity exposure is there. The fund manager goes short, the fund manager takes a contra position to an extent. So that extent is up to the fund manager, up to the AMC. So out of that 70, 75% exposure to equity, apparent exposure to equity, they can go short 10%, 20%, 30%, 40%. So net of that equity short exposure to equity as such can be, say, 30, 40, or 50% of the portfolio. That is the difference between a aggressive hybrid fund and BAF fund. BAF fund is counter-cyclical. Your net exposure to equity is that much lower, whereas aggressive hybrid is whatever equity is there is there. It is a straight, simple product. Investment advisors say that when an investor is nearing his goal, he should shift his investments from equity to debt. Yes. My goal of funding my son's education is 1 year away. What should I do now? So will you advise me to start switching to some BAF? Yes, you can do that. So it depends on the overall level. So if you say switching to BAF, So you may not switch or shift your entire portfolio there. So what you do is whatever pure play equity exposure you have, it could be equity stocks, it could be equity funds, you gradually start reducing the equity exposure. You gradually start increasing your debt fund or debt product exposure. And BAF also is good because the equity exposure is defensive to that extent. But assuming that you don't have everything in BAF, that is only, to an extent, that is the margin kind of thing. Best habit fund, no. There is no best fund in any category. There is no best equity fund. There is no best debt fund. It's like medicine. Like there is no best medicine. It is about appropriate medicine. If you go to a doctor with a headache, he or she gives you a medicine for headache. If you go to a doctor with a stomach ache, he or she gives you medicine for stomach ache. So there is no one best medicine. So similarly, the best fund, or rather the appropriate fund, depends on your objectives, your horizon, your appetite, what you are looking for. It's a function of that. There is no one size fits all. There is no one best product as such. Yes, multi-asset allocation fund should be minimum of 3 asset categories. That is SEBI definition. So the market perception is that multi-asset means equity, debt, gold. 65% or more into equity, balance in debt and gold, yes. But SEBI definition is minimum 3 asset classes and minimum 10% in each asset class. So like one AMC, they run it like say 40 to 50% in equity, 10-20% in international equity, so much to debt, so much to gold, and various things. So it is how the AMC positions it. This is the basic criteria defined by SEBI. That is what the AMC has to follow, and do follow that. Is aggressive able to generate higher return in the habit category? Is there any data? I will not give a one-word answer. What I will tell you is, if you want to track data on returns, there are so many websites giving that data. I would recommend AMFI because AMFI, is the industry body. You simply go to AMFI website, click on fund performance, and you get the data like performance 1 year, 3 year, 5 year, 10 year. You can see. So how much have aggressive funds given, how much have other categories given, that you can compare for yourself. There is no one-word answer. Okay, equity savings versus BAF versus balanced fund. So what you saw in the AUM, what is the AUM or what is the market's preference? You saw that somehow conservative habit funds have not taken over, and equity savings fund also have not really taken over. Somehow the market does not prefer equity savings fund to that extent. And as you saw, BAF is there. BAF is popular. Almost 3 lakh crore is the industry AUM. So the market, the investors, the distributors, the community likes BAF funds. And when you say balanced habit, actually, like I said earlier, as per SEBI, an AMC can have either an aggressive habit fund or a balanced habit fund. And because investors prefer taxation of equity, most of the industry, most of the mutual fund industry, they have gone for aggressive habit fund where equity is 65% or more and taxation is equity. And balanced habit, if an AMC can have it, taxation is non-equity. So balanced habit fund in that sense is not really popular. If you have to compare the popularity, compare BAF with aggressive habit funds. For parking funds for a year for capital protection and equity taxation, which is good. Okay, you want everything in one product. So arbitrage is not bad. So if you hold an arbitrage fund for 1 year, your capital is protected. There can be volatility in the interim, but it's kind of taken care of if you have a 1 year horizon. For a 1 year horizon, taxation is equity any which way because arbitrage funds are by definition 65% or more into equity. Now it's about the returns. So how it typically works is, arbitrage funds typically give good returns when the market is volatile, market is fluctuating, because then the cost of funding means the spread or differential between the equities for an equity futures market is higher. So in a good year, this fund will give you like 8%. In a bad year, the fund will give you like say 4%. And usually they give you like 6.5 kind of percentage. So for the sake of discussion, if you agree that debt funds and arbitrage funds are same, it may be different, just saying that as an example, over a 1 year period, arbitrage funds gives you say 7%, and debt fund also gives you 7% as an example. Arbitrage funds being equity taxation, it is that much better for you. 1 year horizon, it is 12.5%, and debt fund, as you know, it is your marginal slab rate. So that way, arbitrage funds are good. Now, there are other fund categories also, like say BAF funds. Taxation is mostly equity, depending on the AMC positioning. Multi-asset, again, depending on the AMC's positioning, are equity funds, but horizon should be a little longer, like 2, 3, 5 years. If you have a 1 year horizon, I would say don't go for MAF or BAF or all those things. So it can be little conservative like arbitrage funds. No, I have purposefully not shown the return chart. See, the objective of the entire thing, the objective of SEBI, the objective of NISM is to spread awareness, enhance awareness. It is not to pitch one over the other, not to say one category is better than the other, and we never take any fund name. So which is why purposefully I have not shown the returns here that you can track for yourself. There are n number of websites. I will not name any. I'll only name AMFI. So AMFI is the industry body. You can go to the AMFI website. And there are so many other private websites. You can simply do Google and you can see the returns for yourself. What I would say here is people have a typical mindset. Look at last 1 year, 3 year returns, see which one is giving higher returns and invest accordingly. However, that may not be the right investment approach. Some fund or some fund category may have done well over the last 1 year due to certain reasons. There may be a rally in the equity market, rally in the debt market or something that may have generated superior returns. That market condition may not prevail for the next 1 year or next 2 years. So deciding your investment on the basis of this may not be the right approach. You decide basis your risk appetite, how much volatility you can absorb, what is the risk horizon, what is the objective, and which fund category suits that objective. As an example, equity gives relatively higher than debt, so equity is preferable. Within equity, over a long horizon, small caps yield returns higher than large cap, but small caps are more volatile. Accordingly, decide between large cap funds and small cap funds. So that should be the deciding criteria. Like to give an analogy, since we all follow cricket, if you are selecting the Indian national cricket team, your criteria should not be which batter scored a century in the last match or which bowler took 5 wickets in the last match. With due respect, somebody who has proven himself over the last so many years, a proven player should be given preference, even if his last match performance was not so good. So similarly for investments also, returns, yes, returns are important, but not the only criteria or not the decisive criteria for deciding your investments. Best mutual fund, they can start with students to create a good portfolio on mutual fund. So here I would say, being a student, if your horizon, I'm assuming your horizon is long, you're a student today, you have whatever money you have today, afterwards you will start earning and you will do it till retirement. So you can do it through equity. So even though equity is more volatile than debt, you can do it through equity because you have a long time horizon. And equity data shows that as long as you have a long horizon, long means say 10 years, at least 7 years, if you have 7, 10 years or longer horizon, volatility, yes, will be there, but time will take care of the volatility. So as a student, you can start with equity funds. So within equity, whatever category you prefer, large cap, small cap, flexi cap, multi cap, whatever you prefer, you can, or you can do it through index funds also. The expense ratio is lower in index funds. So you can simply buy whatever you prefer, large, small, multi, flexi, whichever category you prefer, you can go through index funds and build your wealth over a long period of time. Is it possible to invest in mutual funds directly by myself without opening a demat account? It's possible. So to the extent I am aware, to invest in mutual funds, it is not compulsory to have a demat account. Demat account is compulsory only if you are taking a loan and you are pledging your mutual fund units. So if you don't have a demat account, you get what we call SOA, that is statement of accounts. You simply get a statement over every, whatever, 6 months or 1 month or something. And that shows whatever holdings you have. It is not compulsory to have a demat account. Demat account is compulsory for equity trading and that kind of thing. What is balanced advantage or dynamic asset allocation? I explained repeatedly. So a BAF fund is where there is an apparent exposure to equity, like 65, 70, 75, 80% of the portfolio. Apparent means long exposure. And out of that long exposure, part of it is shorted. Shorted means the fund manager takes a contra position in the futures market, which negates part of the equity exposure, and the net equity exposure is that much lower. So usually it is 30, 40, 50% as the net equity exposure, which means if the market corrects, this BAF fund will lose to that extent only. As an example, if net equity exposure is 45%, if the equity market corrects, this fund will lose to the extent of 45% only. Whereas if we have a pure play equity fund, the entire portfolio, maybe 95% or whatever, apart from the cash component, almost the entire portfolio is subject to equity market volatility. Is pure debt funds better than FD? So that's a debate. Difficult to give a one-word answer. But one thing in favor of debt mutual fund is that in an FD, provided your interest is more than 40,000 rupees per financial year, you have to pay tax every year. Whereas in a mutual fund growth option, you pay tax only when you redeem. As an example, if your horizon is say 5 years, in an FD, if your interest from the bank exceeds 40,000 rupees per financial year, there is TDS and the balance tax. You have to pay tax every year. Whereas in a debt mutual fund growth option, you are not paying tax every year. You remain invested, so more money remains invested in the fund over those 5 years. You earn on that money, and only when you redeem, not only when you redeem, when your tax payment date comes, that is when you pay tax on that. So that way, plus when there's a market rally, that mark-to-market benefit happens in debt fund, which does not happen in FDs. Contra fund is similar to habit fund? No. There are contra equity funds. So there are only 5 contra funds in the industry. Contra fund is where the fund manager buys stocks where his view is little contra to what the broad market is saying. So if the broad market is positive on a particular stock, he goes negative, or if the broad market is selling a particular stock, the fund manager buys, that's a contra equity fund. That is not exactly a hybrid fund. It's a category of equity fund only. My client is a doctor aged 60. I have provided BAF, MAF, and multi-asset fund. How about minimum variance? I don't know what is minimum variance fund. No, SIF funds are coming. How will they be different from BAF? It's a longish thing, explanation of SIF. Maybe you can do a Google. I have done one article on explanation of SIF. It's published in Outlook Money. You can refer that article on the website of Outlook Money and see what are these SIF funds. How to analyze best mutual? As I said, there is no best mutual fund per se. It's about your requirements, your objectives. So you have to look at the hygiene factors, the pedigree of the fund, the pedigree of the fund manager, how much AUM they have, the performance history, and all those things you have to look at. AUM is size of the fund, rupees, how much money they are managing, assets under management. Size of the fund, maybe say 1,000 crore, maybe 10,000 crore, maybe 50,000 crore. While investing, we should keep aggressive nature or patience. Obviously, patience. See, if you don't have patience, you are a trader. You buy, sell, buy, sell, buy, sell. That's a trading. As an investor, you have to be patient. There is no two ways about it. I have started recently. What is the strategy suggested to invest in a mutual fund? My time horizon is 5 years. So 5 years, you can have some exposure to equity, but you have to balance it out, whether through hybrid funds or debt funds. So no, don't have to put entire money in hybrid fund. You can do allocation, some pure play equity, some pure play debt. And to the extent you're not sure, you can go for discipline through hybrid fund. So best mutual fund, I have said, there is no best mutual fund. So when an income fund receives dividend or something, so that is the fund manager's job. So whatever money, so the fund manager receives fresh flows, flows like dividends and all from companies. So investment of that money is as per the fund manager or the investment team of the fund. It may not be a one-man show or one-woman show. So the investment team of the mutual fund decides that as per their objectives and their reading of the market situation. So like I said initially, the analogy of the bus. The bus driver, so the bus driver should drive fast, bus driver should drive slow, whichever right turn, left turn, U-turn, what the turn should be taken. The bus driver is a professional. He knows the route, and according to the speed, fast, so accordingly the driver decides that. That's how the fund management team decides that. Flexi-cap, multi-cap is not same. So in a multi-cap fund, the definition is 25% minimum in each of large, mid, and small cap. And flexi is 65% or more in equities. There's no cap-wise restriction.
So I would like to extend our heartfelt thanks for taking the time to speak at our webinar. Your insights and expertise and engaging presentation made a lasting impact on our audience. Thank you once again for sharing your time and acknowledgement with us. Wishing you a wonderful day. Thank you, sir.